Hi, everybody. Thank you for staying. Well, I think we have almost as many people now as we did before lunch. That's a pretty good sign, and maybe a few more will trickle in. Anyway, we're going to keep going here. We have two more panels. We're going to get started right now. So we have talked so far about the involvement of academics and municipal planners and policymakers in addressing the problem of global warming. And of course, another important player here is industry, finance, in the investing community, and there certainly is growing interest in climate change issues and policies in the investing community. So we're going to have four people talking about that right now. We're going to have John Mousseau, who is CEO of Cumberland Advisors. John, raise your hand. Thank you. David Kotok, who we introduced earlier, co-founder of Cumberland, is joining us online. We have Henry Smythe, who is Chief Investment Officer of Granville Cooper Gold Fund. He is joining us online, I believe, from the Bahamas. Right? Am I right about that? Well, he hasn't had it all that easy in the Bahamas, as I think he may tell us a little bit. He was there for one of the Category 5 hurricanes. And Steve Gujarro, U.S. Chief Risk Officer for Ascot Group. And our moderator here is going to be Bill Kennedy, who is Chief Investment Officer with RiskBridge Advisors, which means I get to sit down. Thanks, Bill.
Great. Thank you, Rick. Okay. Welcome back. So we did hear about government and we heard about academia. Now let's talk about the private sector and specifically the financial sector. And this will be the question, how are we going to pay for all this? And I'm going to take a page out of Dr. Matt's book to say, I don't know. We don't know. But we do have some experts who may have some views on this. And I do just want to correct David Kotok is joining us, but he's going to be on the next panel. So we will get to David momentarily. But with our experts, John to talk about the municipal market, Steve to talk about what's happening in the insurance realm, and then we will turn to Henry, who is in the Bahamas and has some pretty interesting insights from his experience around Dorian and what's happening on the ground from a financial perspective in the Bahamas. So with that, I'm going to start with Steve because we saw out of Bob's 236 slides, which I memorized and have a copy of each one, we heard that the 1 in 500 storm and the 1 in 1,000 is happening about every year. Steve, how on earth can the industry that you're in, the insurance industry, price that risk appropriately? And specifically, what is Ascot Group doing? By the way, Ascot, Bermuda-based, insurer, reinsurer. Steve's responsible for all of their risk profile across their entire platform. So maybe give us some perspective on what's happening.
Sure. Thanks, Bill, and excited to be here. Climate risk is obviously a topic that's near and dear not only to my heart, but Ascot Group's and the insurance industries as well. So, looking at natural catastrophes, if we go to the chart on the, I guess the left over there, the source from Swiss Re Institute, you really see the rising cost of insurable losses related to natural catastrophes, as that is in real dollars as of 2020. So, focusing just on the last decade alone, if you look at the first half of the decade to the second half of the decade, you saw a rise in cost of almost 27%. That's also coupled with the fact of greater uncertainties of events, whether it being record-breaking wildfires, polar vortexes in Texas, hurricanes creating higher intensity and historic flooding levels. All those type of events are really causing, significant loss and uncertainty in that pricing. Insurance is one of the few industries where you don't know the cost of goods sold until at the beginning of when you're pricing the business. So usually these greater levels of VUCA, which is volatility, uncertainty, complexity, and ambiguity, that usually leads to a higher level of risk premium that you price into the exposures going forward. However, during that last decade, we didn't really see that up until kind of the last few years, and a lot of that was driven from an influx of alternative capital from wealth management funds that were looking for an undiversified asset that also could produce a higher yield given the low interest rate environments. That said, the last 3 or 4 years has really led to, quite catastrophic levels of loss for those type of institutions. And now we're starting to see a pullback capital just given where the level of pricing is. So what that means overall is that, in order to get the capacity and capital needed to fund some of these climate risk changes, we're going to have a reset of what the technical price of risk really is for these type of exposures. So what does that mean for consumers and businesses? Well, one, that means that there's going to be tightening of terms and conditions, which creates more contract certainty from insurers. It's going to likely mean increased deductibles and lower limits, which is passing on some of the loss potential burden onto the consumers themselves, as well as just increase in premium costs as well. Now, there is a silver lining to this, and Lord knows we need some silver linings after some of the doom and gloom that we've heard so far, and that's that, these rising costs can be an impetus for change. What we'll likely see is, companies like myself and other insurance companies, we're going to put heavier emphasis on data analytics and modeling to really optimize our risk distribution across our portfolio. So what that's likely going to lead to is that companies that have invested in infrastructure that can withstand, the potential of some of these rising climate risks, as well as have embedded loss mitigation policies into their plans, they're going to be the ones that are going to get capacity from insurance companies. So this is really going to hopefully fuel some of the investment in infrastructure that's necessary for us to combat what's coming around the corner. It can't solely be done, and we've heard from academia, government, it can't solely be done by the private sector and the consumers themselves. It's going to have to take a holistic effort, whether it be, government increasing funding for such, creating economic incentives for these change, as well as taking on some of the burden of those extreme event tail risks that, the private sector just can't price for effectively and put on their balance sheets. Then you're going to see insurance companies also create some incentives for this by also creating funding for it. But more importantly, creating some of that financial surety through other programs such as surety bonds, builder's risk, that helps make the likelihood of investing in these more practical. And then finally, it's going to take that less impetus of the customer base and businesses to finally realize that the cost of not doing something is going to be far greater than the cost of doing something now.
And that might be the catalyst to make investment, not worry about the expense, but the investment for the future.
Correct. Yeah, I mean, businesses, they're going to follow the dollar, right? So if something's cheaper to do, they're likely going to waive that. So now these rising costs, it's going to create that economic incentive fire that, hey, let's make some change. We were actually talking yesterday at the drinks cocktail, and Bob's son-in-law was mentioning how, he lives in Denver, and 5 years ago, any of the car dealerships, you didn't see any roofs. But because all the historic hail that keeps coming in there, well, now their insurance costs went up, their deductibles went up, and it's like, if I'm paying $500,000 every year because of these hailstorms, well, it's a lot cheaper putting up this $250,000 roofing. So you're starting to see that balance where the economic incentive is better to do something now than later.
Steve, definition, tail risk.
Oh, so tail risk is, sorry, that's the pocket protector in me coming through over there, right? So it's it's those really large, those 1 in 500, 1 in 1,000 year type of events that are really extreme in nature but have very severe loss potential where, to price for those risks accordingly in the private sector, it's just not going to be economical. And that's where, the government has to kind of come in and provide that protection and to help the consumers be able to understand that they're going to get help in those situations, and then that we will find a way to be able to finance climate risk.
Okay, great. Henry, are you there?
I am.
Let's see if we can get Henry on screen. There he is. Welcome. It's good to see you.
Good afternoon, everybody. Thanks for having me.
Oh, absolutely. So, Henry, give us a little bit of perspective. We had a conversation in prepping for this about.
No. I'm listening to a presentation.
Bill, turn off your mic.
All right, Henry, floor is yours.
Good afternoon. I live in Freeport in the Bahamas. I'm sorry, I don't have a lot of experience in public speaking, as you'll see. We've been here since 2014. We moved from Westchester County in New York, and have been through a number of hurricanes in my life, including we came in the aftermath of Hurricane Matthew in 2015. And we really didn't, we made a major miscalculation by not getting off the island prior to Hurricane Dorian. But there was not this sense that this was going to be something that was going to be what in fact it turned out to be. It was a tropical depression for a long time before it hit. And when it hit, we lost all communications. So we had no idea that it was slowing down, or frankly, the damage that it had done and the devastation that happened on Abaco Island, which is just to the east of us. So if you picture the island, it's sort of like a shallow V. It's about 100 miles wide. And just north of it, for at least 50 miles, is very, very shallow water. So when the hurricane slowed down and ultimately stopped about 35 miles north of Freeport, what it did was it was at least sustained winds at 150 miles an hour. And so what happened is that it beat this water, like basically an egg beater sitting in shallow water, and it's pushing this water up against the north side of Freeport. It had nowhere to go except over the land. So at one point, I saw later, there was a satellite photo that showed about 3/4 of the island was underwater. And as the force of this built, the surge, especially near the area of the canal that bisects the island, the storm surge there was 29 feet. And it's difficult to imagine that much water moving that quickly over this land, which is in essence flat for the most part. The highest elevation on the island is about 40 feet. So everything that had been planned pretty much was out the window in 2 hours. The communications went down. The National Emergency Management Agency was out of communication. They got flooded. They had to be evacuated. All the people who used churches as sanctuaries, a lot of them had to be evacuated because the churches got flooded. The hospital was flooded. It was out. From the time that we locked our door until we opened it again was 44 hours. It's difficult to describe what the toll that actually takes on you, not only physically and emotionally, but mentally as well. For sure, I've got PTSD, and I'll probably have it for the rest of my life. And it is the most significant event, I would say, in my life. And in a way, the only way I was able to cope with this was the connections that I had to other people and that I made in the aftermath of this.
So Henry, sorry to interrupt. If you can pull your mic away just a touch. There you go.
Okay.
Thank you.
So all of this is to point toward some things that I think I drew away from this. And one is that even now, the government, it's been 2 years. You would expect a lot more rebuilding than in fact we've seen. The airport is still not working. The harbor is working. There has been a net movement of people off the island. And the long decline that had been going on here continues. I doubt the population is 30,000 people. At its height, it was probably 84,000. It is a net drain on the finances of the Bahamas that are already strained. The Bahamas has been downgraded several times, just recently at the change of the new government. It was a gargantuan burden financially for the government. The property loss estimates range anywhere from $4 billion to $7 billion. And there is obviously throughout the Caribbean, not just in the Bahamas, a huge gap between losses and insurable losses. I've heard some figures that say probably only 25% of the property in the Bahamas is insured. And my guess is that will probably be the case for some time. It's difficult to see what can change that. The other part of this that I've noticed here, and have noticed for a long time, is this phenomenon that we call de-risking, which is banks, insurance companies, for the major have basically pulled back out of the Caribbean. This used to be the domain of the Canadian banks. They have been throughout the Caribbean closing branches, reducing their footprint. They're hoarding cash. They don't make loans. And this has been a burden on the Caribbean, and something that they bring up a lot in international venues, and yet nothing really happens. They have lost a great deal of their financial services capabilities, their insurance. I mean, Bermuda is the recipient of what used to be a vibrant insurance and reinsurance market. The Cayman Islands basically took the bulk of the fund business. And it's not to say that they are innocent in any of this. They have definitely been in large measure responsible for the decline of their fortunes. But when you hear them speak, and you could hear this repeatedly during the COP26, each one of the leaders that got up said basically, you created this problem, not us. Therefore, it's up to you to come to a solution, to provide us the financing, to provide us the solutions. I don't think that's going to change anytime soon. I think there are some hopeful signs. We helped to organize a foreign bank to come in and make a proposal for a refinancing program for the government of the Bahamas. And they did so, and it's under consideration. And one of the things that they put in there was what's called a blue bond, which is a form of indenture that includes some kind of marine preservation as part of its structure. So the government of the Belize is now negotiating one of these for their sovereign debt, and hopefully we'll be able to do one in the Bahamas as well.
So Henry,
I hope that's been...
Oh, very helpful. Thank you for the perspective and the insight. John, so Team Cumberland is all about risk and reward. Given everything we learned from Bob this morning, is the muni market risk going to be so high it's uninvestable? How do you see the muni market being impacted?
Thanks, Bill. And, among the many hats I wear at Cumberland, the one I've worn the longest is managing the bond area, and specifically the municipal bond area. So this is a good topic. It's like anything else. It's one of price, right? You're in an environment now with very low interest rates, so there's very little distinction between bonds of the same maturity but different quality levels. That will change as you move to a higher interest rate pattern, and it will eventually change because of climate, right? And we think this will be ongoing, and it's taking a lot of different measures. I have just a couple of things here to show. All politics are local, right? So I just decided to talk a little bit about Florida, but in this microcosm of Florida, you have some of the changes that are going on in the municipal business and how risk is being priced. So here's Florida with a large coastline, a low elevation, very severe weather, as we know, getting worse, and population concentrated on the coast. With Florida, you have, I think, 67, 68 counties. 35 of them are coastal, and about 75% of the population is there, and about 80% of the output of Florida is from these areas. So clearly the area at risk, the question is, as a bond investor, do you want to take that risk, and are you getting paid for that risk? And this is true everywhere, right? So if you're looking up in South Carolina, where you get regularly beat up by tropical storms and the like, and large damages to areas along the coast, you'd say, well, do I want to own a small general obligation bond from a coastal area of South Carolina when I can go own the University of South Carolina and get the same yield? And the answer is no. And these are the kind of things that happen over time in portfolio management. It's like, how do I reduce my risk and keep basically my yield the same? Or if I'm going to try to achieve higher yield, I want to be paid for taking that higher risk. There's some long-term, real estate effects here going on as well, not only in Florida, but also in these other areas. And you're finally starting to see it, right, with the way FEMA is pricing insurance in these coastal areas. It was pretty much just a not standard fee, but really lower quality dwellings and stuff were really paying the freight for bigger dwellings when you looked at the way the price is going. That's changing now. And, some people are seeing their premiums, quadruple, quintuple. And that's probably a good thing, because what you don't want is basically free riders, which has been going on for a while. And that sifts over into the muni business as well, because, how do you know if you're buying a bond deal, whether the disclosures are adequate? And that's what's changing right now in the business. So there's one mistake on here. I put on here that in Florida, you do have 1,000 people coming in per day. That is actually not 80 million, but that's 80 million visitors to Florida, down last year from 131. As we speak, that number is going to be going a lot higher than it was pre-COVID. And if any of you doubt it, just take a trip to the Sarasota airport, because in the old days, and I moved here in 13, you could get there 30 minutes before your flight. And that doesn't happen anymore. You better get there early, because they either need more TSA and more gates, because there's a lot more flights and a lot more people coming and going, for sure. A lot of bond deals in Florida. This is just some of the deals that have, come just since basically the summer. Water, wastewater deals. This will be ongoing and growing. And if you look at the amount of issuance in Florida over the last few years, it has not only grown, but for the most part, it has grown as a percentage of all bonds issued in the United States. And that's not surprising when we know how many people are moving to Florida. They may change the SALT provisions in the tax bill with deductibility for state and local property taxes and state income taxes. That may slow the migration to Florida, but only temporary, because you're still seeing this pickup and saying, I can do better by moving to Florida or Texas from a tax standpoint. We don't see that changing. What you see, particularly in the financial area of things, is that what kind of disclosure? Because this is where you have the risk laid out for you as a bond investor, particularly on a new issue. And there's a lot of people fighting back on that. They don't want to disclose. And obviously, you can imagine an area like Miami probably is going to have the biggest problem with disclosure when you look at the sea levels rising, what that means, particularly in the coastal areas, what that means. Think about building authorities and the tragedy that happened in Miami. So there's lots of groups that want to throw rocks into this process, and there's a fight back on this, and there's the people that will continue to deny there's a problem, and they'll say, well, we just had this storm that crushed everything, but it's a once in 100-year event. Boy, what did we learn this morning? We learned that a once in 100-year event is followed by the once in 500-year event, and followed by the once in 1,000-year event. So when you see those numbers, and I was very appreciative of all of Bob's slides, is that, boy, we're not getting paid enough now for the risk that we're assuming. I mean, that's really what it comes down to. And where you will see this is in the bond business. There's municipal bond insurers out there, right? So there's a few of them, but the big ones are really Build America Mutual and Assured Guarantee. And they put their own backings on bonds that are usually rated by A or BBB. And if the issuer for some reason can't pay, they step up and pay. And the biggest example of that are the bonds that have been paying off in Puerto Rico for the last 7 years since Puerto Rico went bankrupt. So they assume a lot of risk. They will be stepping in, and I'm sure looking to charge more for their insurance premiums, particularly in these coastal areas. And let me tell you, if you have less disclosure, you're going to have higher premiums you're going to pay if you can get the bond insurance. So as you move into some higher interest rates over the next couple of years, which we think will happen, because look at the inflation numbers, there'll be this sorting out process, which you haven't had in a while, between the haves and have-nots from a disclosure standpoint and the haves and have-nots from a risk standpoint. And in our business, in portfolio management, the real challenge is how do we approach that on a day-to-day basis in terms of measuring our risk to our clients. There's a big movement going on, and all of you read about it, for ESG investing, right? Environmental, social, and governance. It seems like everybody and their brother is trying to do it, so we're not really trying to get into that. What we're trying to do is refine our own credit methods so that we can actually, for our own existing clients and existing portfolio bonds, have a measurement of what that ESG risk is, and some of that is clearly climate risk. So what we really want to do is tell a better story of what we own, because ESG investing is pretty broad-based. If you're the state of Massachusetts and you're issuing a general obligation bond, it's AA rated. If you're the state of Massachusetts and you're issuing a bond for a building that's a clean, solar, green building, it's the same obligation, state of Massachusetts, same full faith and credit, but it qualifies as a green bond. So my point of it is that there's not really much distinction in credit quality there. What you really want to be able to drill down to is what's the real risk, and things like climate risk are much more important within that framework. So
That's something the Cumberland team's doing. They're doing that.
we're trying to do it now. Yeah, and it's an ongoing process. And the harsher the weather, the more it's going to become important as we go forward. I mean, I can remember, and David will remember this too, Kotak. We go back to 2005 with Hurricane Katrina, and this is before a lot of GPS stuff, and we were sitting there with pins on a Ram McNally map trying to put where the different impact points would be about Katrina about 5 days before it hit. And we ended up selling bonds for somewhere between the middle coast of Texas right to the Florida Panhandle, and thankfully sold New Orleans bonds along with it. Today you have a lot more tools at your disposal. You can do that, but that's the kind of thing that where you thought, boy, this doesn't happen very often. Boy, it's happening more and more.
Steve, let me come back to one thing. I think I heard you say greater severity, greater loss, our property premiums are going to go up. But there's another source of capital that could alleviate some of that pressure, more supply of capital coming in from different markets away from traditional insurance. Is that
Yeah, I mean,
correct?
you saw a lot of that influx from wealth management funds as they were looking. They saw property catastrophe risk as a good diversifying asset, especially where interest rates were. When you're in such a low interest rate environment, you weren't getting a much risk premium for some of those high credit risk bonds, corporate bonds. They saw prop cat bonds as a good way to kind of invest in a uncorrelated type of an asset class. But you're starting this year, typically you would see a lot of those funds already re-upping capital by this time. And now maybe a bunch of them will come in at the 11th hour right before the end of the year and redeploy some capital. But we haven't really seen that yet in the industry. So that's going to be a reduction in capacity, which, reduction in capacity, that's going to have to lead to an increase in price to make it more attractive so that you can bring in that capital to fund some of these climate risks going forward.
I warned you this is where they were going to boo you off the stage.
Yeah.
So, forewarned.
It creates the incentive to invest more, right? So that should be the positive side of the matter.
Exactly.
And, insurance, unlike, when you're dealing with municipal bonds, right? You're trying to make bets on something that's 20-year bonds, 30-year bonds, right? The one advantage that insurance does have is it's a one-year product. So you can reprice that. But the challenge is how do you price in, or how do you get people to buy into the price of a 20-year, 30-year type of an exposure like climate risk into a price currently now, and I think that's really what's slowed some of those pricing increases, kept capital involved. Now that they're starting to experience some of those heavy losses, capital's getting a little bit scared. It's not, oh, I put up some capital, I'm going to get a good, 800 something basis points on this risk, much better than what I would get for that similar type of a credit risk in the traditional, asset market. Well, now if you're taking principal losses, plus there's trap capital, as part of the other issue with a lot of these storms is not just the event that happens, but the demand surge that requires it. Texas, the power grids were out. It took so long to get there. Pipes were bursting, created a lot of mold, all these type of situations. These flooding events, some people aren't able to get to those homes for a couple of days. That increases the amount of loss, and it increases the cost on, well, how many plumbers are really in that neighborhood, right? So that supply is also creating these and delaying when those payments, where you're starting to see some of these catastrophes are actually a little bit of a longer duration before they can close out than they had in the past, which that also creates some uncertainty whether to invest in or not.
Okay, I'm going to go to Henry, back to John, and then we'll open it up for questions from the audience. Henry, are you there?
Yeah, yeah. Actually, I want to follow on Steve's comment because I think there's something that I saw. I was taken to the landfill. Like everything is basically goes into the landfill here in on Grand Bahama Island, and obviously all the debris from Dorian was taken there. And one of the things that you see is an absolutely staggering amount of drywall that was destroyed after these houses got flooded, right? And most of the houses are one-story, concrete block, metal roof, and the windows are at a level kind of like you see in the old sort of 50-style Florida ranch houses on which they were based. Well, if there were anything that could mitigate that, you would have had like an enormously smaller amount of debris, and this debris was taken out of the houses. There were all of these relief groups that came in and helped them strip this stuff out, loaded up on the front lawn, and then it was basically months before it was taken away, in the heat of September in the Bahamas, which is one of the hottest times of year. So, if there could be some fairly dramatic changes in the way construction is viewed throughout the entire Caribbean, I think that would address some of these issues that Steve is bringing up in terms of the insurable loss and also the time it takes to calculate the insurable loss as well.
So Henry, talking about construction in the Bahamas, share with the group what you shared with me about the investment you were making on a storage facility and what worked, what didn't
All right.
work.
Yeah, so since I got here, I'm working with a group of local investors and American investors to build a high-value storage facility and in Freeport on the airport, which flooded, by the way. So our old design was basically a traditional warehouse, overbuilt, obviously high security. It would have been fine. It would not have flooded. It would not have been damaged by the wind. It would not have been damaged by impact. But after the hurricane, I sat with the shareholders, including the shareholder who's going to manage the construction. And I said, you know what? We need a different paradigm. I think that we need to do something that takes us, in essence, a few decades ahead. And we started looking around. And actually, in that picture that Bob Bunting showed earlier of Mexico Beach, there was another house that was there that caught my eye that I had read about called a monolithic dome. And I started doing some research and then pulled in my construction shareholder. And we started looking at this. And in the end, it basically, we did a complete redesign of this project. And so that's what we have now, a 2-story monolithic dome, over-engineered, tilt-up concrete walls. And the advantage of this is not just that it mitigates the effect of water flow horizontally, but also wind, but also impact. So in addition to being a commercial venture for us, we also hope that this will end up being a demonstration project to Freeport, to Grand Bahama, to the Bahamas, to the Caribbean, of what is sustainable architecture in the present day. What will take us this could be used as a shelter, as it is in Tornado Alley. These things are often found now, and they work perfectly. So we shall see. We shall see. But this is something that I would like some academic interest in this, and as we go along, and certainly some interest on the side of the insurance and reinsurance. You know, is this viable and should this be pushed? Because then you can go to government and say, the amount of your GDP that has to be reserved for this can be lower if you in fact put this kind of architecture in your country.
Terrific. Thank you, Henry.
Yeah.
All right, John, completely unfair question, so that's why I'm asking you. Cost of capital for governments, for corporations to get that investment made so that we can achieve our climate objectives, cost of capital is going to go higher. I don't know if it's through the roof or incrementally higher.
Sure.
No one knows. Is all of this inflationary? And can we expect sustainable inflation as a result of the investment on climate?
It's really, two-pronged, right? So you have these costs going up, and they're subject to supply chain issues right now too, right? So if you wanted to do reinforcements, make buildings safer, put in the kind of mechanics that you're going to need to do in Miami, which will try to turn into a mini Venice over time, right, with filtration and water pumping systems. You're not going to get all that today because you have the supply chain issues. So the answer is yes. On a local level, it contributes to inflation. We personally think that inflation is going to come down from the levels it is now, but it probably settles in at maybe 3 to 4% as opposed to the 2% the Fed has been espousing for so long. But it doesn't take long, right? Take 4% inflation and compound it, for about 12, 15, 14 years, and you've doubled the price level. So, one of the problems that municipalities.
Where's a 10-year bond right now?
10-year bonds at a 155. Pardon me. So it's very much under the rate of inflation. So one of the problems the municipalities themselves have, though, is the fact that they're so diversified, right? So you have, in the corporations, you have a few thousand issuers. In municipalities, you have 50,000 separate issuers. And on top of that, you have 1 million separate issues out there. So, I mean, it's a very, very diverse group. So trying to get standardization of disclosure agreements, trying to get standardization of data aggregation is all a big challenge, and it's one that the industry has got to really take seriously over the next few years.
Great. Okay, questions from the audience? Anybody?
I have one.
Except Bob. Please.
So it sounds to me like, what we're really talking about today is risk reduction. Climate warming is a thing, but what we're talking about is lowering the risk on society. And that's what you money guys are all about. I would suggest you hire a climate scientist. I'm done.
Any recommendations, Bob? Okay.
That'll be in a few budgets, Bob, I'm sure.
Yeah, absolutely. Please join me in thanking the panelists. Thank you, guys. Oh, I'm very sorry, very sorry. I jumped the gun. Yes, sir.
Sorry. I'm Ed O'Carroll. I work with Climate First Bank. And on the insurance side, I'm curious, as you're assessing whether it's flood insurance or property liability insurance, are you giving credit to the quality of the construction? So he mentioned a monolithic dome. Would that reduce an interest rate or a policy on the insurance if you were based on the structure, not just the location?
Yeah, I think that's you're going to start to see the differentiation, right? The modeling is becoming much more sophisticated, right? And that's, to your point, construction codes, the quality of risk, that's where you're going to see the capital being deployed, right? That's one of the things that our company has been focusing on is that quality of risk, rather than just putting that straight line for a region and say, okay, we can only charge X dollars per thousand of premium of limit. Well, how do we start differentiating that due to the quality of risk? Is it better to get, would you rather insure like a $1 million frame building or $1 million reinforced concrete with some of those construction codes? You might not get the same level of premium, but you're going to get a better risk return. So there's a lot of focus and emphasis in insurance now on that risk-adjusted return on capital. So if I have to I might get a little bit less premium, but the amount of risk that I have to hold from a capital perspective is down. Well, those are the risks that are going to get insured, not the ones that are much higher volatility. So that's ultimately those, there's always a price point for risk, right? So, but if it's, half the value of the house for a yearly premium, you're going to have to start changing how that structure is in order to make the cost of insurance more effective.
So just to wrap this up, I do want to say, again, thank you. All three of you are in the return business. There is no return without risk. Bob, your point about mitigating risk, it's about reducing the uncertainty. And I think that's really what provides that opportunity from an investment standpoint, that things are going to be okay going forward, but it's just measuring that return opportunity relative to the uncertainty. And the work that you're doing, and I think that this conference has provided, is helping to reduce that uncertainty. So thank you. Thank you, everybody.